Halal mortgages. Are they truly interest-free solutions or just interest by another name? With Canada now exploring new rules to expand access to halal mortgages, more people are asking, is this the real alternative for Muslim Canadians or just clever rebranding? Let's dive into it in this segment. So what exactly is halal mortgage? Unlike a traditional mortgage that charges interest or riba, halal mortgages use structures meant to comply with Islamic finance principles.
Riba is not allowed in Islam, and the Quran and Hadith prohibit riba very explicitly. So, Islamic mortgages or halal Sharia compliant mortgages basically are structured in a way that there is no interest, but there is asset backed or asset based mechanisms which create a halal profit for the financier. So, for example, the financier will purchase the house and resell to the customer at a profit, or they will purchase the house and rent it out to the customer at a profit. And those are halal structures because they do not have interest. And that's the key difference between the two.
In Canada, Muslims now make up nearly 5% of the overall population. That's about 2.2 million people. In the Toronto region alone, that's more than 10% of the total population, over 600,000 people. And with the community being younger on average, more and more are entering into the housing market and are curious to learn about halal mortgage.
Canada has a $300 billion halal mortgage market, which is expected to increase to about 700 billion in 10 years.
The demand is clear, and providers are stepping in. In fact, Canadian companies have already financed tens of millions of dollars in halal mortgage deals. And in Budget 2024, Ottawa formally announced consultations to expand access to products like halal mortgage.
The customers are basically approved based in the same way and on the same factors as a conventional mortgage. We look at their income, we look at their credit score, we look at their ability to pay off the mortgage, and we look at their um, general other expenses and how much the mortgage will cost compared to their overall expenses. So we look at all of these things, and based on that, we do the approval of the mortgage. At Iqraz, if you go to our website and click apply now, you will see that there is a process that customers do. There is a mortgage calculator which helps them understand based on their income what is the amount that they can qualify for, which is based on these criteria. And these criteria are spelled out partly by the Canadian regulator and partly by the Canadian banks.
So how does a halal mortgage really differ from a conventional mortgage? To begin, there are no interest charges. Instead, you are paying profit or rent. In terms of contracts and oversights, some providers use Sharia boards and global Islamic finance standards. More importantly, when it comes to pricing, it is often benchmarked to the same market rates as regular mortgages. So while the structure differs, your payments may look similar.
That according to Quran, Surah Baqarah, verse 275, Allah has prohibited usury but allowed trade, even though the end result may be the same from a financial cash flow point of view. So the way the profit is calculated in a halal mortgage is exactly the same way from an amortization point of view, how a conventional mortgage is calculated. There's no difference because it has to be the same. Otherwise, Islamic finance will not be able to integrate with the conventional finance world, and it cannot grow. So they are both calculated in the same way. It's the structure of the halal mortgage that makes it Sharia compliant, not the calculation.
Here's where it gets interesting. Depending on the structure, there could be extra costs, like additional legal fees, admin charges, or even double land transfer taxes in certain setups. That's one reason why Ottawa is reviewing how to smooth out the rules. So it's important to compare the total cost and not just the monthly payment.
Talking about the different halal mortgage product types in the world, there's three types, but two of them are very similar. Musharaka and Ijara are very similar. So let's just call it a Musharaka, which is a diminishing partnership along with the rental payment. And then there's a Murabaha, which is Murabaha means cost plus sale. In a Murabaha product, if you come to me with $1 million request to buy $1 million condo, I will purchase the $1 million condo. Then I will add a profit of say $400,000, which is basically the similar to what the interest would be over 25 years in a conventional mortgage. And then I sell the house to you for 1.4 million. But there's a big problem with that. Imagine you want to sell the house 6 months later. You will sell it at the original market value, right? Around $1 million. But guess how much you owe me? You owe me $1.4 million. So that product is not a popular product because it's almost it's unaffordable, and there is a capital gains and land transfer tax that is incurred twice, because first I'm buying the house, then I'm reselling it to you. So that is the reason it doesn't work in Canada. So that's the Murabaha product, completely out the window. Neither the customers nor the regulator nor the lenders want that product. The other product is the Musharaka product, which is the diminishing partnership product, similar to Ijara, which is a leasing. In that product, you and I co-purchase the property, and I then rent you the property. So instead of interest payments, you pay me a rental payment every month. And every month, I sell you a small slice of the property. So instead of principal, you're paying me a home purchase payment. The same amortization, the same monthly payments, except that it's principal, a home purchase, and profit payment in a Musharaka, not principal and rental. The problem with the Murabaha product is that I buy the house from 1 million, sell it to you for 1.4. You are now stuck with that 1.4 million payment, and it incurs double capital gains and double land transfer tax. Doesn't work. The problem with the diminishing Musharaka product is that as a lender, I have to own the property in partnership with you and rent it out to you, which means what happens if the property is sold 5 years later at a profit of 100%? The customer doesn't get to keep that. I keep my share of the profit. Now, I could give that share to the customer, but if the property is sold at a loss, then Sharia law requires me to participate in that loss, my share of the loss. But a lot of the companies that are issuing Musharaka products hide that, and they don't have that. So it's not subjectively, it could be non-Sharia compliant. The other problem is the lender, because they're owner of the property in a Musharaka product, they have to bear all the TMI, the tax, maintenance, and investment, and other risks, along with the borrower in their proportion of the shares. So in a Musharaka, a lender will own 80%, borrower will own 20%. The lender must take the 80% of the risk of any loss in the property. So those are the reasons that these traditional products do not work in Canada. And ICRAS has come up with a unique product which is based on an Islamic concept called reverse Murabaha, which is used by every single Islamic bank in the world. But we are the first ones to apply it to Sharia compliant mortgages outside of maybe a couple of banks in Malaysia.
Halal mortgages are growing fast in Canada, but with costs and structures that can feel complex, the conversation is just getting started. The question is, will Ottawa's review make them truly competitive, or will they remain a more so of a niched solution? As always, thank you so much for watching, but we're curious to know what you think. First of all, is halal financing an option that you will ponder the next time you buy real estate? And for second, are there any questions that you would like for us to ask the expert and answer on this show for you? If so, shoot them in the comments below. You're watching GTM Muslims Today. I'm your host, Moiz Rahman.